Hello everyone. So in the today's session, we'll be running through or discussing RTP May 2024 series of our financial reporting. Okay. So before we start, so how is the overall RTP? So pretty much okay, sir. We have maybe 2-3 questions or maybe 3-4 questions which are a little new adjustment. But other than that, all the big numerical questions are all pretty straightforward questions. Okay. So I would say on an average RTP. Okay. So yes, so without delay, we'll get started. One. So we have two cases. So both these case scenario number 1 and case scenario number 2. Okay, both the cases that we have over here, I've already covered this. I did a video called case-based MCQ of ICI. It's available on YouTube also. In fast track and regular course also, it is available. In YouTube, if you search ICI case-based MCQ by Sandesh, you will get this video. So in that particular video, both these case scenarios are already covered. Okay, or if you don't want to search in YouTube, it's available in paid version and fast track and regular version also. There also you can find it. The first two cases in that video are these. Okay, so repetitive already done, so I'll not waste your time or my time in that discussing. So let's get started. So the first 10 questions of RTP are already covered. 11th, so question number 11. So again, in this video, only those things which are which are little new or different will be covering. Those questions which are repetitive. I'll give you the referencing number of the class notes. You can watch that and get that done. So this question number 11 is there as question number 10 in our India 103 ka class notes chapter. All this referencing is from the regular batch. Fast track batch also, all these questions will be available. The numbers you can check for based on this. Okay, same question is available. So let's not worry about that. Okay, so next one is question number 12. This question is on ethical duty. Remember professional and ethical duty of CA. So this particular question is on that. So we'll cover this particular question. Question number 12. Astra Limited is a listed company which operates in defense and fiber optic sector. Great. It supplies fiber optic cables and racks in domestic country. They're supplying some fiber optic cable for internet. We require fiber optic cables. No? That supplier we are. This activity is only trading activity, so we are not manufacturers, we purchase and we sell. Okay. The sale contract requires Astra to deliver the goods to IT companies. So one of the terms of the contract is we are not only sell these cables, but we have an obligation to deliver this cable also. That's the way we make the sale contract. It means indirectly the question is saying what the revenue should be recognized when performance obligation is satisfied. Here performance obligation will get satisfied when we deliver that fiber optic to IT companies to our customer. So revenue will be recognized only when the goods are delivered based on the components given in the question over here. Yes, no? Okay, the payment terms are 30 days after the invoice date. Okay, that's the payment part. Now, Ms. Suparna Dasgupta is a CA. She has recently joined Astra as the head of finance department. So one CA has joined the finance department and she's heading it. The COO, Chief Operating Officer, also the Executive Director of Astra is Padmaja Srinivasan, a mechanical engineer with an MBA from Harvard. Okay, all that we don't require. Her remuneration includes bonus computed as a percentage of turnover. How much ever is the turnover revenue, on that she'll get some bonus achieved during the year, and additional incentive on achieving an EBITDA in excess of as in earnings before interest, tax, depreciation, amortization in excess of 15% of the turnover. So if the EBITDA crosses 15% of turnover, some extra incentive she'll get. Okay, that means her motto is to increase the revenue. If revenue increases means obviously this particular director will get more incentive. Now Astra Limited has sold a fiber optic cable amounting to 2 crore rupees to Ethernet Bullet Limited, one company. Okay. The service unit of Ethernet Bullet Company is located next to the factory of Astra. So our factory and customer location is adjacent, Ajubaju. Okay, next to each other they are. Though the goods were not moved, underline the word not moved to Ethernet. So you can recognize the revenue based on previous paragraph. What? When the goods are delivered to the customer. Here goods have we delivered? No, keep that in mind. The goods were not moved to Ethernet Bullet service unit. Astra recognized of the sales. Okay, they were in hurry. They recognized of. Okay, goods are not yet delivered. That means what they've done violates India's 115. Based on the contention, company is justifying saying the service unit is adjacent and hence the transfer can happen within few minutes. Within 2 minutes, Maggie, we can supply off the cable. So we are not worried about delivery. So we recognized off. So if you are so much, why didn't you deliver first? Correct? No, you should have delivered. Yes. They are saying it's only next to our building. We'll aram say whenever we want, we can deliver, and the delivery will take only few minutes. So we will not wait for delivery. Immediately we'll recognize. Sorry, boss. That and all is not acceptable. Your obligation is complete only when you deliver the goods to the customer. So revenue should be recognized only when the delivery is completed. Currently, it is not yet complete. So revenue recognition should not have been done, but they've already done. Now, the annual results are due for board approval and for the year ended and require sign off of Miss Suparna Dasgupta. So she is heading the finance department now. So she has to sign off on financial statement. Then only it will get approved. Miss Suparna Dasgupta has been given a 40% increment on joining Astra, which enables her to comfortably pay off her housing loan mortgage. Additionally, she is also given perquisites in the form of business class travel. She's been given a lot of stuff for joining this company. Accordingly, she has stated that she cannot afford to lose the job as the salary and perquisites are among the best in the country. She's saying, I cannot lose this job. So you got to know the ethical dilemma over here because they've done something wrong. Suparna has to sign off on this, right? So if she does not sign off, probably she'll lose her job and all this incentive she'll lose. But what they've done is wrong. So ethically, she's not supposed to sign off on this. Yes. Now, the other director, Padmaja Srinivasan, has communicated to Suparna Dasgupta that many more benefits will accrue if she agrees to present the numbers without any modification. So, if you just sign off, I'll give you more, that Suparna CA will be getting more incentive in future, it seems. She has also said that the company would not hesitate to replace Suparna Dasgupta should she agree with contentions above. So, if she says she'll not sign off, then she might get fired. Okay, so now you are required to analyze what is the ethical situation. Keeping that ethical principles in mind, you need to write the answer. Okay, now 4 or 5 points if you write, keeping that as a base and write additional points, that should be good enough. One, you can call out the accounting treatment done by the company violates AS 115, Ind AS 115, correct? No, because in this particular case, revenue should be recognized only when the goods are delivered. Here, delivery has not happened. So company is saying our customer factory is next to us only, so delivery can happen within few minutes and all. That acceptance or that contention and all is not acceptable. So basically what they have done is currently violating Ind AS 115. That 2-3 points you write. Okay, no need to write too many. Okay, that is on the accounting treatment part. Now on the ethical issue, what is the ethical issue? Chartered accountant is saying every chartered accountant has to adhere to the ethical guidelines given by ICA. Yes, no, CA Act is there, we have to follow. The ethical issue over here is the conflict of interest. Now Suparna Dasgupta, if she signs off, she'll get a lot of incentive. So it's a personal interest. But she also has a duty towards shareholders that to represent the truth. Correct? Now we have to present the truth well. Truth should come out. Okay. But what they have done is a violation of Ind AS 115. So here purely there is a conflict of interest. It's a personal benefits versus duty towards shareholder. Because if she does not sign off, then she is adhering. She is following her duty towards the shareholder. But she'll have to forego the personal benefits which she is getting. So that's one conflict of interest, which is the ethical issue over here. Second one is if she says, I have no idea. When I studied, when I cleared my CA, it was only accounting standard. Ind AS was only new principle. No, probably it is only 4 or 5 years back only they introduced that. If she says, no, I am not aware of this Ind AS 115 provision at all, and she sign off, that is also, that is what, sir? Absence of professional competence. Professional negligence it will be, correct, sir? You have to continuously improve your knowledge. Just because you cleared your CA examination doesn't mean that knowledge has come to an end. No, you have to go on updating. Whatever necessary changes have come, you need to update it. So by ignorance, you can't take the seat of a cushion of ignorance and say I didn't know, I did not study at that time. And all, that is not acceptable. So if signed off in ignorance, then absence of professional competence, that particular ethical issue will arise. So these are the ethical issues. Now what the action this particular CA Suparna has to take? One, sir, she is responsible for presenting the financial statements in its true and fair form. Okay, you can't violate or give some incorrect data. That is wrong. Okay, she has to always put the ethical duty and the interest of the company first. Personal interest is always secondary. First, the interest of the company, the overall stakeholders always has to be adhered to. So that's what you need to write. And basically, what is the conclusion? She should not let influence. Here now, her boss is influencing her saying, sign off, I'll give you more incentive, otherwise we will fire you. All that influence she should not come under, and basically she should not sign off the financial statements because it is what financial statements have been currently prepared is wrong. If she still signs off on this financial statement, then she will be guilty of professional misconduct under Clause 1, Part 2, Second Schedule of CA Act of 1949. If you can remember, that will be great, this particular things. Okay, so this much if you write some 5-6 points, that should be good. Okay, so these are some, that's the reason I've listed out the point, because study material has given too much of para and all. So we just list out this in this form. I think that should be good enough. Little more masalas and all if you want to add, that is okay. I've just given my own masalas for this particular case. Done. Yes, so this is about case number 12. That's question number 13 is on Ind AS 22 income tax. Same question is there. Not ditto, but similar question is there in question number 20. So if you do that, automatically this will be taken care of. So nothing much there. Question number 14. This is a good question. Okay. So we will be covering this. This is on borrowing cost. 1 second. I hope there is no issues, people. Yeah, there's some system issue which we are facing since 1 or 2 days. So some problems are there. Okay. All right. Hopefully things are looking good in the recording. Yeah. Okay. Ind AS 23 borrowing cost. PQR Limited is engaged in tourism business in India. The company has planned to construct a holiday resort, and this holiday resort they're saying is a qualifying asset. Some resort they're constructing. Okay, at Shimla, that too. Nice place. They're constructing a resort. Yes, no. The cost of the project has been met out of the borrowed funds of 100 lakh. So obviously you have taken a borrowings of 100 lakh at the rate of 12%. So you have taken one specific borrowing. So it's a specific borrowing. This obviously when you take a bank loan, bank also will not release the entire amount in one go. No? First 40 lakhs was disbursed on 1st April. Bank gave us on 1st April. Second disbursement of 60 lakh came on 1st June. That's okay. Disbursement is irrelevant because for specific borrowing, what do we check, sir? The total loan amount multiplied by the rate and multiplied by the construction period. If construction period is 10 months, then we will capitalize the interest only for 10 months into 10 by 12 we'll do. If construction period is 8 months, then we'll do 8 by 12 like that. So this disbursement is irrelevant for us. Okay. Okay. The site planning work commenced on 1st June. We know, sir. Sir, you might have taken the loan on 1st April. So you can start the capitalization on 1st April. No. So for borrowing cost ka capitalization, 3 conditions should be satisfied. The day on which all the 3 conditions are satisfied, that day only you can capitalize. What are those? One first condition is borrowing cost should be incurred. Second one, expenditure on qualifying asset should be incurred. Third one, activities relating to qualifying asset should have begun. And activities here does not mean physical activities. Even if you're doing some planning activity, administrative activity, even that is considered as activity for this purpose. So the day all these 3 conditions are satisfied, that day you will go ahead and recognize or you will start the borrowing cost ka capitalization. Okay. So now here site planning work commenced on 1st June. Planning activities are also okay. It's acceptable. It's considered as an activity for this purpose. Loan is already taken. Okay. So yeah. So that is already done. Okay, then sir, what is that? Now borrowing cost has already been incurred, activities have already been incurred, assuming that the amount is already incurred. So capitalization starting date will be 1st June. Since the chief engineer of the project was on medical leave, that's the reason there was a delay. 1st April May we had to start, but ultimately 1st June only we started because engineer was on leave. The company commenced physical construction on 1st July. Physical construction is irrelevant. Planning activities is good enough for us. And the work of construction continued till 30th September. So from June it started. And it went on till 30th September, no problem. I mean, 30th September, it completed as well. Let's read. And thereafter, construction activity stopped due to landslide on the road, which leads to construction site. Obviously, these are all hilly areas. No, sir. In hilly areas, usually landslides and all are pretty common. So there was some landslide. Okay, that's the reason probably the road was blocked. So that's the reason construction got stopped. And the road blockages have been cleared by the government machinery by 31st December. Okay, that means what, sir? From 1st October to 31st December, there was a road blockage due to landslide. So construction did not happen. So construction went on only from 1st June to 30th September, which is how much? June, July, August, September. How many months? 4 months. For October, November, December, 3 months. Due to landslide, the construction was stopped. So which concept is this? Suspension of borrowing cost. We remember we did a small concept. So borrowing cost you will suspend when the active development on qualifying asset has got interrupted, we used to say. If the active development of the qualifying asset, if it has stopped, means suspension, borrowing cost for that period will not be capitalized but transferred to P&L account. That means this 3 months period will be transferred to P&L asset. That depends. 1 minute. Right, start erasing only. Yeah. What to do? See, another problem. New problem. Okay, let it be. Okay, sir, this 3 months borrowing cost will transfer to P&L then, sir. That depends. It depends on what, sir? Sir, in this particular Shimla area, whether landslide is common or not common, you need to check. If landslide is common in that area, then this is part and parcel. We knew when we started the construction only that landslides are common in this area. So that means it is part of the work. So in that case, this 3 months capitalization will not stop. It will continue. Meaning even this 3 months borrowing cost you will capitalize only. But suppose if you say no, in that particular area of Shimla, landslide is not at all common. Suddenly we came no. So it is a rare event. In that case, we'll say that active development has got interrupted. Then this period borrowing cost will not be capitalized. It will be transferred to P&L. Maybe how to find out? Usually they will give this data. Whether it is common or not common, landslide, they will give you in the data. Let's see. Okay, the construction activities have resumed on 1st January. Again, 1st January, construction started. And then they are saying, and completed on 28th February. Okay, so 28th February, it is completed. Okay, that is what they've given. The date of opening has been scheduled on 1st March. But unfortunately, district administration gave permission for opening only on 16th March. So we had to take the permission to open this resort, but that permission we did not receive on 16th March. I mean, sir, can we stop capitalization on 28th February or 16th March? That again depends. Whether this approval which you are sorting from the government or receiving from the government, is it absolutely required? Is it a major approval, or what is it? You need to just check. Suppose if you say you cannot do any activity without taking government approval, suppose it's a major activity, then you can say the borrowing cost qualifying asset has got completed only on 16th March. If you say all these are just for the sake of formality, usually government will approve it off, there is no big deal. That question will specify. In that case, we will take 28th February as the date on which qualifying asset has got completed. Yes, no, because we have already studied the concept of cessation of capitalization. Cessation of capitalization means when will you stop the capitalization? You will stop the capitalization when qualifying asset is 100% complete? No. When qualifying asset is substantially complete is what the standard uses. Okay. What is substantially complete? You need to analyze from a case-to-case basis. So here that substantially completed may mean 28th February or it could be 16th March. The question will provide that, we'll see. Okay, due to some lack of, they delayed the approval to 16 March because they feel there is some safety measure ka lack, which we had to, like fire extinguishers and all, we had to install, which we did not install. That's the reason they gave us the permission to operate only from 16th March. Now, determine the borrowing cost to be capitalized towards construction of resort under two cases. One, they only told, check, landslide is not common, meaning in this particular area, landslide will not happen regularly. And delay in approval from administration is a minor administrative work. So it's a minor work, not a major work. So this approval that you've sought from the government, no, it's not a major work, it's a minor. That means in this first case, you can stop the capitalization on 28th February because the work is, since this is a minor one, this approval from the government is a minor work, you could say qualifying asset is substantially completed on 28th February only. Okay. So first case, what are they saying? Landslide is not common. So if landslide is not common, then that becomes, you have stopped the work from October to December, no, here. Okay, that becomes an abnormal event. So can you capitalize this? No, this period ka borrowing cost will not be capitalized but transferred to P&L. That means what is the capitalization period from June to September? 4 months. Then again work started from January and went on till February. No? That means how many months? 2 months. This 4 months ka, this 2 months ka. Totally you will capitalize only 6 months ka borrowing cost. That's what I've written over here. Okay, sir. So total borrowing cost is 100 lakh. Disbursement is irrelevant. The loan amount is what is relevant over here. What is the loan amount? 100 lakh. What is the interest rate? 12%. So 12% is per annum. You will capitalize only 6 months in this case. So in the first case, you will capitalize borrowing cost only to the extent of 6 lakh. Good question. I mean, solving wise, there isn't much to solve over here, but conceptually, it's a good question, you could say. This is under case 1. Second case, landslide is common. Now they're saying landslide is part and parcel of this area, Shimla area. Okay. In that case, you cannot say that active development of qualifying asset is suspended because there's a temporary delay because this was expected. Okay. If it was expected means we call it as a temporary delay. If it was unexpected, then it becomes a permanent delay. In case of a permanent delay, we suspend the capitalization, meaning borrowing cost we will not capitalize for that period. If it's a temporary delay, then capitalization will still continue. Since they're saying it is common over here, even this period, for what period of the work got stopped due to landslide? 3 months. Even this period, interest will be capitalized. Okay, then that is first part. Then they're saying delay in approval from the district administration is a major administrative work left over. In this case, they modified. So we have to open the resort, we need approval from government. No, from the first case there, they said it is a approval from government is minor. Now they are saying it is a major. If it's a major means unless this approval is received, you cannot say qualifying asset is substantially complete because they're using the word major. So in this particular case, what sir? The qualifying asset is substantially complete not on 28th February, but on the day you receive the approval, which is 16th March. Okay, they're saying landslide was common, so this period of capitalization also will still continue. So you have to capitalize from what? From 1st June to 16th March, you need to capitalize. Suspension is not required. So June, July, August, September, October, November, December, January, February, plus half a month of March. That means 9.5 months. So in the second case, you will capitalize borrowing cost for 9.5 months. That's all is the period. Okay, just the calculation difference. Okay, like this, they will only give the data, what it is, and accordingly you need to solve. That way, this is a good question in my view. Work is question 14 is that's all. I think we can dive into question number 15. 1 second. Okay, the next question is as on Ind AS 10 and Ind AS 109 ka combo question. Again, a good question, I would say. A simple one, but conceptually good one. The company has made a sales of 60 lakh rupees to a customer SS LLP on 31st December. Okay, fine. The normal credit is 1 month. Great. However, sometimes it goes up to 2 months. Okay, sometimes we don't receive the payment within 1. It goes up till 2 also. The company expects to receive the payment by 28th February. We sold on 31st December, no? So company feels within 2 months maximum, we'll receive the amount. That 2 months is 28th February. However, no payment has been received till 31st March. So due date is already on 28th February. 1 month over, we approach the year end 31st March. Payment we did not receive. Okay. The 15th April, May, the sales department of the company became aware that the customer is passing through financial crisis and has a major cash flow problem. Okay. So now, sir, on 28th February only, we had to receive the payment. We did not receive. That means what? We did not receive because the customer is already facing some financial crisis. So on 31st March or before, condition of this financial crisis was already existing. We got to know about it later. Okay, don't say it is non-existing event. Okay, our department, sales department, got to know about it on 15th April, but customer was already going through financial crisis. So it's like an error. If you remember, we solved some questions on error. Okay, error was already committed. Fraud or error was already committed. You detected later on after year ending. So like that. So we treated that as an existing event. Here also same drama. The customer are already going through a financial crisis. Just that we detected this or we came to know about this on 15th April. Okay, and there was a delay in 1 month also. That means the condition was existing. So this financial crisis while a condition was already existing on balance sheet date or before. So what sort of an event is this? This becomes your adjusting event in this particular case. So till now, this is your Ind AS 10 answer. Okay. Now why will Ind AS 109 come into picture? So debtor is a financial asset. For financial asset, we do Ind AS 109 accounting. So now let's see what happens. The company agreed to allow the customer to settle the debt by 31st March 20x4. Okay, keep the date in mind. Sir, we are on 31st March 20x3 currently, and we have to receive how much from the customer? 60 lakh. Since that particular customer, maybe he is our long-standing customer, we've been transacting with him for a long period of time. 31st March, May, current year, we did not receive. So since because of our relationship, we told that debtor, no problem, we understand you're going through some problems. You can pay us by 1 more year's time. So we had to receive the payment by 28th February only, and we are on 31st March 20x3 currently. Company is saying no problem, take 1 year's time. By 31st March 20x4 you pay. By which time customer is confident that the cash flow problem will be resolved. So 1 year extra time we gave, and we told the customer pay that 60 lakh later. So currently the financial asset debtors is shown in the books on 31st March 20x3. Currently we are showing the debtor in our books how much? 60 lakh. The question is, are we right in showing on 31st March 20x3 debtor of 60 lakh? Yes, no sir, we will receive 60 lakh. Yes, we will receive 60 lakh. When? We will receive this 60 lakh not this year, by next year. Next year we will receive 60 lakh. So we know the concept of time value of money, right, sir? We are currently showing the debtor at 60 lakh, but this 60 lakh we will receive not now, but after 1 year. So showing the debtor 60 lakh now is wrong because this 60 lakh we will receive only in the next year. So hence what we have to do? Find out the present value of the 60 lakh. This 60 lakh you will receive after 1 year. So it is your future value. Find out the present value of the 60 lakh. So for that we need discount factor. We'll give check. The company expects annual interest rate of 9%. Effective interest rate can be received against money lent out. That they give discount factor. That's okay. Determine the amount to be shown as trade receivables for 31st March 20x3. For the current year, how much debtor will you show? Simple. Currently we are showing the debtor at 60 lakh. Can we continue to show it at 60 lakh? That will be wrong, because this 60 lakh we will receive not now, after 1 year. So after 1 year we will receive 60 lakh. So that 60 lakh is the future value after 1 year. So find out its present value. How? Taking a discount factor at 9%. So 1 divided by 1.09 if you do, you'll get discount factor of 0.9174. So 60 lakh is a future value, multiplied by discount factor you do, you'll get the present value. Okay. So this particular debtor in the current year, you cannot show it at 60 lakh because 60 lakh is a future value. So currently carrying amount of debtor is 60 lakh. The present value of future cash flows becomes, after considering time value of money, the present value becomes 55.05 lakh. So that means from debtor of 6, currently you are showing 60 lakh. No? From 60 you have to bring it down to 55.04. So what is that? We don't know. So on this debtors and all, you have to book impairment loss as per Ind AS 109, not as per Ind AS 36. Yeah. This is a financial asset. Financial assets ka impairment is as per Ind AS 109 only. Yes. So from 60 lakh, if you reduce it to 55.04, the balancing figure 4,95,413, that is the impairment loss that you have to book it in the current year. Why current year, sir? Because it is an adjusting event. Okay. So hence current year we have to book an impairment loss of 495,093. And the value of debtors that you will show in current year 31st March 20x3 balance sheet is not 60 lakh, After booking impairment loss, it becomes 53.04587. That is the value of debtor you have to show it in current year ka financial statement. We have not done such question. This is an entirely new question. Good question. Small, okay, if you just see hardly 3-4 lines. If you write this much, you will get 5 marks, 5 to 6 marks. That's all. Okay, but a good question conceptually. And makes sense also, right? No? According to me, this is again a good question, I would say. Yes, people. So this is done then. I think I can move forward. Next is question number 16. No? Again, this inventory also a little good question. Little different question. Small, but good question in my view. B Limited, one company. They valued the stock held for distribution as free item on claim by customer on offers at 0. Some inventory, no sir, they valued at 0. So why have they showed at 0? Because inventory to be valued at cost or NRV, whichever is lower. How is this 0? Sir, are we selling this inventory? No, we are giving this inventory as a free item. We are distributing this as a free item. Maybe we have seen this, no? If you buy one item, you will get one more item, one more sample item, you will get it free and all. That whole offer is probably going on here. Maybe company has introduced a new product. Okay. So they have released one offer. Any customer who purchases the old product, one existing product, they will get that new product free of cost as a sample. Okay. So that one offer company is doing. Since the NRV of this free item, this item is 0 because we are not selling this. We are giving it away for free. Yes. No. So net realizable value of this free item is 0. That's the reason this inventory is valued at 0. So what they have done is right. There may be cost. But NRV is 0 because we are distributing it free of cost. So hence, you are showing inventory at 0. That looks fine. Customers have a right to claim this free item within 14 days from the date of invoice. So today, if he buys the goods, within 14 days, he has to ask for that free item. It's not automatically given to him. Within 14 days, he has to put a claim saying, I want this free item. Then only we will give it. That's one condition. If the time limit of 14 days exceeds, the claim will have to be foregone. So if the customer does not claim for this free item within 14 days, we will not give him, we will not entertain it. Okay, that is one. The majority of free items requires online registration by the buyers for participation in the context conducted by the respective brand, which needs to be done by buyers within 3 days from the invoice date. Okay, I mean, there are 2 conditions to be satisfied by the customer to get this free item. 1, he has to claim for this free item within 14 days from the invoice date. 2, he also has to do online registration within 3 days. Today, if he buys the goods from us, today if we sell the goods to him, right? Or to that entity has to make an online registration for this free item within 3 days. So within 3 days from the sales date, they have to make a registration. Within 14 days from the sales date, they need to claim. If both of them are satisfied, we will give them the free item, otherwise. Okay. Alright. Out of it, a few items under this category were found damaged. Out of this category, free item. We are giving some free item. No. Some goods of this free item are already damaged. Okay. Now, damaged item, can we give it to the customer? No, if you give it, obviously the customer will say, what sort of faltu product you have given me, a waste product you have given. So we'll have to repair or replace. The replacement cost of such item would be 2,50,000. Since a few items, free items, products, they are damaged. Okay, the replacement cost we can't supply free item cost. If at all you have given some damaged product to customer will complain. So we'll have to replace that inventory. To replace it, we'll incur an additional cost of 2,50,000. Okay, determine whether entity has to book the loss of inventory or provide for replacement cost needs to be given. So they are saying, should we make a provision for 2,50,000? No, that is the question all about. Okay, inventory valuation is okay. Since NRV is 0, you can show it at 0. That's all right. This 2,50,000 you have to pay additionally, no, because few free items are damaged. Should we make provision for this? Is what they are asking. Okay, that's all as a funda of this question. So that depends. You have to give a subjective answer here. So why, sir? Sir, this free item, every customer will get it. No. Only those customers who fulfills 2 conditions will get it. What are those 2 conditions? 1, within 3 days, yes, up from the sale date, he needs to register. And within 14 days from the sales date, he needs to claim. So that means what, sir? If the customer does not claim or register within the time limit, then we will not give him free item. Then provision in that case is not required. If you are not even giving him free item, where is the point, or where will repairing the damaged free item will arise? Yes. So if customer does not satisfy these conditions, means no provision is required. Okay, which how will we know? Entity has to estimate. Okay. However, if the entity feels that some customers will claim and do the registration within time limit, then provision for 2,50,000 has to be made. So we have to give a subjective answer here because they have not given the data to conclude. Okay. So it depends basically. If customer does that necessary processes within the timeline, we have to make a provision. If entity feels the customer is not going to complete that particular registration and claim process within the required time, then the provision for 2,50,000 is not required. Both answer I've called out. This much if you're right, It is good enough. So simple but chintu but good question. That's all. Question 16 also over G. Can we go to question number 17 G? Yes. Question number 17 is on cash flow statement. Again, a very straightforward question if you ask me. Okay. But anyways, just to be on the safer side, we don't have the same question in our notes. Similar question, enough number of questions we have solved. Okay, 5-10 minutes may quickly we'll run through this question also. Balance sheet of March they have given, sir. They have given balance sheet. That's all. Then they have given some additional information. We'll read the additional information. That way we'll get to know if we have to prepare any ledgers. Profit before tax. Normally under operating cash flow, use indirect method to get operating cash flow. Usually under indirect method, the starting point usually is PBT. It could be PAT also, but the preference is profit before tax. That profit before tax only is given to us in the question as 200 lakhs. Provision for tax is 40. We'll see that later. PP has been purchased for 100 lakh. Current liability includes capital creditors for 25 lakh. Capital creditors means, sir, you purchase some equipment, no? Okay. Maybe you have not made the payment. How much you purchased the PP for 100 lakh? The capital creditors includes 25 lakh as on 31st March 2023. Their opening balance was nil then. At the year beginning, there was no opening balance of capital creditor. Capital creditor simply means we purchased some capital assets like plant and machinery, PPEs, etc. and not yet paid the money. So the journal entry you will pass is what, sir? You purchase PP account debit 100 lakhs to what? To vendors, to financial liability. Okay, this they are calling it as capital creditors. How much is there? 25 lakh. That means out of 100 lakhs, 25 lakh you have not yet paid the money. So 75 lakh rupees you have paid the money. So this is the journal entry for your PP purchased. Okay. Okay, this is important to us because we don't want PP purchase. We want cash outflow related to PP purchase. So though you purchase PP for 100 lakh, the cash outflow is only 75 lakh. So this number is what is relevant to us. Okay. And this particular 25 lakh of capital creditors, no, it's included in normal creditors. So normal creditors we include under working capital changes. Okay. So when we say creditors, it means creditors related to goods. Okay, related to your normal goods, not capital creditors. For machinery, PP, intangible assets and all, if you purchased, if that creditor and all, no, it should not be put under working capital changes. So we need to exclude this 25 lakh because it is included, no? So exclude this capital creditors and then do your calculate the creditor. Normally for your current assets, current liability, we check, no, increase or decrease in current assets, current liability, we give the effect in under working capital changes. So this 25 lakh excluded and then do that comparison is what they're trying to tell. Long-term borrowings have been raised to the extent of 120 lakh. It's a financing activity, no? So we have taken some long-term borrowing. So it's an inflow under financing activity. You have to show it as plus 120 lakh. If you want, we can tick off that here. Where is it here? If you want to just check financing activity, 120 lakh they've added. Okay, that is done. Okay, the starting point is profit before tax of 200 lakhs. Okay, sir. So we have got to know, and even this also we can check off. So though you purchase PP of 100 lakh, the amount paid is only 75 lakh. So this will come where the 75 lakh will come under investing activity as an outflow. So check, have they shown investing activity purchase of PP 75 lakh outflow? Yes, that's it. Now we will dive into the question one by one and go on ticking. First they've given 31st March 20x3, then they've given 31st March 20x2. So last year ka closing balance will become current year ka opening. So this is opening balance. This data 31st March 20x3 ka data is your closing balance. Okay, PP we have got the information. Just for the sake of it, if you want, you can prepare the ledger also, because I think we didn't see any depreciation. So hence maybe, and we don't see any accumulated depreciation also data over here. Hence PP ka ledger you make it better. Opening balance 410, closing balance 450 given. And we purchased PP worth how much? 100 lakh. Entire payment done? No, only 75 lakh done. So to bank 75, to financial liability creditors 25. Just now I showed you the entry, that posting we have done. Okay, no other transaction is there. So this side total is 510. This side also is 510. You're getting a balancing figure on the other side, which is 60. Sir, can't I take it as sale? No. Sir, you have used the asset for an entire year. No. So this 60 lakh, it needs to be assumed. But a better assumption is what? That these are the 60 lakhs is the depreciation relating to PP. Okay, because sale of PP is not compulsory. Depreciation more or less will come on PPs. Yes, no? So depreciation is arrived as balancing figure. That's a better assumption. And depreciation, what we have to do? So non-cash expenditure added back. Check if they added back depreciation. In solution, yeah, here depreciation is added back as per working note number 1. If you just check, that is the depreciation added back. Got it, sir? Like this one by one, we'll go on ticking. So these two are done. Next, intangible asset, opening and closing same. So no movement we can ignore. Then deferred tax asset, no movement we can ignore. Other non-current assets. Usually they will mention, if they don't give any data, put this under working capital changes. We have done this same question in one of the problems we've seen. Yeah, in that problem that specifically told other non-current assets and other non-current liability should be shown under working capital changes only. Like that, they're given a particular pointer in the question. If here nothing is given, but we'll still show under working capital changes only. We can't do anything. So opening is 85, closing is 95. So there is an increase of 10. Increase in current asset means what? Minus. We know this. No? Increase in current asset means minus. Decrease in current asset means plus. Increase in current liability plus. Decrease in current liability minus. I have told you the logic of all this in regular class. Now I'll not go into all that. Yeah. So here there is an increase. Increase means reduce. Check under working capital changes. Have they reduced 10? Increase in non-current assets 10 they have reduced. Okay, next, what is the next one? Investment. 60 became 100. From 60 it has become 100 means we have purchased additional investment. So what about sale? We read the information. There is nothing about investment. 60 has become 100 means obviously it's due to increase. We have purchased additional investment worth 40 lakh. Investment purchase is what activity? Investing activity as an outflow. So 40 have they shown under investing activity as negative? Check. Investing activity, acquiring investment, 40 they shown as negative. So that part is covered. Next, trade receivables. Trade receivables comes under working capital changes. Opening is 600, closing is 580. So there is a decrease. Decrease in current asset means plus. How much decrease? 20. So decrease in trade receivables 20 have they shown as positive number? Yeah, here decrease in trade receivables 20 they have shown as positive number. So that is taken care of. Next, next is cash and cash equivalent. Be careful whenever you see cash and cash equivalent. Usually cash and cash equivalent we have at the end. Opening cash and cash equivalent we showed at the end with that category, and closing cash and cash equivalent we have a separate category. But you will show cash and cash equivalent after considering bank overdraft. Even bank overdraft is part of cash and cash equivalent only. Do not forget this. Okay. So if you see bank overdraft, all this we have done. It's the same. Similar adjustment is there in our regular class also. So when you say cash equivalent in opening cash and cash equivalent in cash flow statement, you have to consider this and set off with bank overdraft and then only show. Like opening balance. How much is opening balance of cash and cash equivalent given? 300. How much is opening balance of bank overdraft? 420. Net off these two. So 300 debit balance and then 420 overdraft ka credit balance. That means it is 120 credit. Yes, no. That means opening cash and cash equivalent is we don't have that much cash. It's an overdraft scenario. So 120 you have to show it as negative as opening cash and cash equivalent. Check where here. Opening cash and cash equivalent after netting off bank overdraft. Same thing we have to do for closing also. So closing cash balance is 300, overdraft balance is 410. From 300, if you do minus 410, you'll get 110. So 110 is the negative cash and cash equivalent balance at year end. Okay, this is one adjustment. Do not forget this. Okay, then inventory. 700 has become 800, so increase in current asset means minus, so this has to be reduced. Other current assets also same thing. 120 has become 160, so increase means minus. 140, both they have minus. Check. This is your 100, this is your 40, both they have deducted. That's okay. Next, so these are done. Maybe we'll take off this. Then these are all totals. That's okay. Equity share capital. This is your opening. 250 has become 280, so it has increased. We didn't see anything in the adjustment, so it has increased due to we have issued some additional shares. How much? 30. Issue of share is a financing activity. It's an inflow. So 30 have they shown under as a positive number under financing activity? Yes, they've shown. Considered. Next, other equity irrelevant because we already got profit before tax, so that is irrelevant. Borrowing they had given some adjustments, so we prepared a ledger for it. Opening balance 300, closing is 360. Opening balance 300, closing is 360. In the adjustment they had told we had taken additional borrowing. How much? 120. What is the journal entry for loan taken? Bank account debit to financial liability loan. So you'll post it as buy bank. Correct? That's all they have given. So this side total is 420. This side also should be 420. It is not matching. You're getting a balancing figure. So 60. It's coming on debit side. So that means this is loan repaid. So in the current year, we have some loan taken also, loan repaid also. That's the reason we prepared this particular ledger. So loan taken 120 is a financing activity plus, loan repaid is a financing activity minus. So 120 plus 60 minus. Taken up 120 already ticked off, 60 minus we got it here. Okay, sir. Yes, sir. This is over. Other non-current liability, no information. We'll put it under working capital changes only. Opening is 80, closing is 90. So it is increased. Increase in current liability means plus. So 10 have they shown? Yes. Non-current liability increase, they have added. That's okay. Then trade payable. Trade payable, we need to be a little careful. Opening is 450. No problem in the opening. Closing they've included some capital creditors also, meaning some creditors associated with PPE purchase, which should not be. So opening is right. Closing is not 455. How much have they included? It includes 25 lakh of capital creditors. Closing balance, clearly they have told. Yeah. So closing balance of 455 includes capital creditors of 25. Eliminate that. So actual closing balance of creditors is only 430 after eliminating this capital creditors. Opening balance 450, closing is 430. So for what's up? From 450 it has become 430. So there is a decrease. Here there is a decrease in current liability. Okay, decrease in your creditors. Decrease in current liability means minus. So 20 is a decrease. So check, have they reduced to 20? Yeah. They've written the word increase there. That's a mistake. So but the treatment they've given, right, it should be deducted, which they have. Okay. So that part is okay. Other current liability, if you read the question, they gave provision for tax, right? We did not see any provision for tax. So the assumption is this other current liability. Provision for tax is a current liability, no? So this other current liability is nothing but provision for tax is an assumption, and a valid one because they gave provision for tax and adjustment also. So this 40 lakh is a provision for tax made in the current year given. So this current liability, what they've given, opening and closing balance, we'll assume it as provision for tax and prepare the ledger. Opening balance of provision for tax is 90, closing is 45. So by balance brought down 90, closing is 45. Current year, did you make any provision? Yes. The journal entry is SPL account debit to provision for tax. So the posting will be by SPL. This they've given an adjustment 40. So this side total is 130. This side also should be 130. Not matching. We have a balancing figure. How much balancing figure? 85. That is nothing but we just make the provision and keep quiet. No, we'll also settle. No. So there's nothing but your tax paid. So 85 tax paid. I mean, show it at the end. Okay. They have shown other current liability. I suggest instead of this, write it off as tax paid. My 85. So this show it at the end. Okay, sir. Yeah. So that is also taken care of. Anything else we have? No, this is done. This is total. This and all is total. So it's fine. All adjustment also we stuck off, I think. Yeah, it's okay all. So if you just check, everything is ticked off. This is total. This is total. This is also total. This is also total. Okay. This is nothing but A plus B plus C. Adding all the activities ka cash flow. Total again. So things will get matched up. Good question. Just the bank overdraft part and the capital creditors part, you would say. Capital creditor part was not included in any of the previous problems. So that way, that is a good adjustment that we can learn from this particular question. Rest everything is pretty straightforward. Okay, so with this question, cash flow statement also is a Damarchi. I'm trying to keep up a faster pace because I know that some of you will be watching this on the last moment. So I don't want to waste too much time. Okay. Normally you play it at 1.25, 1.5. No, this time I thought I'll only increase of my speed and make it as 1.5. Yeah. So that's the reason I'm going a little faster. Hope you are able to keep up. Yes, you should be able to. Yeah. I'm just saying. Yeah. Okay. Next is question number 18. This one also a small question, but I would say a good question. Just theoretical, but a good question in my view again. Revenue from contract with the customer. India is 115 question. So they are asking, the requirement is they've given some data and they're asking you whether these components can it be considered as a separate performance obligation. All this. So performance obligation means what? Performance obligation is a promise made in the contract with the customer to transfer the customer a distinct goods or service or a series of distinct goods or service which are substantially same and have the same transfer pattern to the customer. Yes. And when can you say goods or service are distinct? Goods or service can be distinct when the customer can benefit from the usage of the goods on its own or with the resources available with the customer, and the goods should not be highly interrelated or interdependent. Okay, so all this we have studied. This is the definition of performance obligation. We have done enough number of questions on PU. Okay, now they are giving you this data and asking you whether all these are single performance obligation or can we consider them as separate performance obligation. A property sale contract includes the following. Sir, you have purchased a property. Let's assume apartment because the data given resembles like an apartment. So you purchased an apartment, let's say Mantri Builders, Shobha Builders, or whatever, Shapurji, Palanji, whatever builder. Okay, from one builder you purchased a property, an apartment. Okay, now they have this particular apartment. It also includes the following. One, it includes common area. Obviously, when you purchase an apartment, you'll also get a common area, the lobby where you keep the shoe racks, so blah blah, cycle, shoes, chappal, so many things people keep now. Yeah, all that. Is that common area a separate performance obligation? Now you tell me, sir. Common area alone you can purchase? No. Means what? That apartment which you purchased and common areas are highly interrelated, interdependent. Right? One cannot function with the other. Correct? Now, common area you cannot purchase separately. So will this be a separate performance obligation? No. That's all. So you have to simply write performance obligation card definition and just conclude. That's all. Okay. These are common area and property sale contract are highly interrelated. So it is not a separate performance obligation. So answer mein they've given study material answer, they've given big story. Okay, you write this para. That's the reason I've given an answer over here. PO ka definition you write. Write one justification. Now these two are highly interrelated, so not a separate performance obligation. That is good enough. No need to write full story. If you just check quickly, I'll show you study material solution. For a minute, I was also taken back. What have they written? Full story. That was just for the explanation. See, this is the answer. Okay, first they gave this story. PO ka story they gave. Okay, alright, much we wrote. Then this story. Okay, then again one more story. 3.5 page ka solution they have given. Don't know. So no need to write so much and all. Just write PO ka definition. And then justification and final answer is good. Okay, that's the reason I've written the answer for this. Construction of service and building material. Obviously, sir, apartment means to construct that building. Okay, you need a lot of materials and other services also will be there. No, construction service, right? This construction service, maybe you have made a contract to buy the apartment. Apartment is still probably getting constructed. Maybe in the last stages, we don't know. Yeah, is that construction service building material a separate PO? No, sir. Can you buy this material alone? No. So obviously, when you buy an apartment, the material and all will be already used to construct that particular apartment. Yes. So these two are what highly again interrelated. So again, the second component is also not a separate performance obligation. How about property management services? So like in the apartment, you already have the service, no? Watchman service, CCTV service. Some you will have some people to some grocery service will be there. Correct? No, some an entity will manage all this garbage disposal, cleaning the common areas, installing CCTVs, maintaining visitor records. Correct? No, parking sticker, making sure that correct people are using the parking space, etc., etc. All that is property management services that you can give the contract alone. Yes, no, correct. You can change the vendor also. Have you observed? Yeah. 1 year property management service may be given to one company. Next year you may give it to separate entity. So this is a separate service. So this can be treated as a separate performance obligation because this is not really connected with your apartment. These two can function independently. You can have property management services. You may not have it, right? You can have it with one company in 1 year, have it with another company in another year. So you can take individual service of this. So this is not highly interrelated or interdependent. You can call it as separate PO. Golf membership. Again, this depends, but usually in apartment space, the way I know, in fact, on the big builders and all, if you go, right, normally this golf membership now may be open to the other people also. Meaning not only the apartment people have the golf membership, it will be open to the other public also if they want to subscribe. So this golf membership usually you can purchase separately. Again, you have to analyze the facts of the case, but on a usual ground, this can function independently. Hence, these two you can treat it as a separate performance obligation. That's what the answer they've given in study material also, and I kind of agree with that. Then car parking. Car parking, all depends. In my view, it can be a separate PO, okay, because usually you can let it out, okay. Yes, because if you don't have a car, you purchased an apartment, you got automatically you got a car parking space along with that, right? Now, this car parking space alone, can you rent it to somebody else? Yes, you can. Many people do that also. Yes, even I have done it. Alright. Yeah, I have the multiple extra car parking space which I've let it out. Yes, someone asked, I told, okay, fine, why not? Extra income, no. Yeah. So, car parking space, you can actually let it out. You can give it, you can, selling doubtful, okay. It depends, your status, so you can, alright, but usually you can rent it out. So that way it can function independently. So it depends, you have to just check. So that's how study material has given the answer. But generally, you can consider car parking as a separate performance obligation. Land entitlement. So when you purchase an apartment will be constructed on the land. That land, is it a separate PO is what they're asking. Now all the apartment people, whoever has purchased the apartment in that area, in that particular building, all have a share in that land, no. Right? This land, is it a separate PO is what they're asking. That depends. So if this land, if you can sell separately without selling the apartment, this land, apartment owners also have a right towards land entitlement. If this land alone, if they can sell it separately or if they can pledge it. Like if you want to take a bank loan, normally if you have purchased an apartment, you'll know this. For building, there will be a separate contract. One agreement will be there. And for land agreement also, there will be another agreement. Or that agreement may only will say that this particular holder will be entitled for this much cents of land or this much area of land, like that they call out. Okay. So if this land portion, if you can sell it separately without selling the apartment, or if you can pledge for taking any loan, then it can be treated as separate performance obligation. So that depends, okay, depending on how you have entered the agreement. So these two you can give a subjective answer. Okay. So that's how the answer is given. So you can stick to the same solution there. Okay, so that's all. So this way, this is a good question, a small question, but a good one. Okay, just I told you how to answer also. Okay, question number 19 is on Ind AS 110. This is a repetitive question. This is there as question number 98 in our regular notebook. You can refer to that. Same ditto question, no change. You can manage that. Last to Ind AS 102 ka share based payment, they have added one question. This is a good question, not a new concept. We have discussed this. Okay, but yeah, probably the way they have asked is slightly different. Just that same concept, they have stretched it a little bit and tried to make a new question. I'll give you a little background and then we will read this particular question. One second, guys. All right. Now, question number 20 ka. Now, sir, share-based payment. You will issue the shares. Now, normally, majority of the problems we have solved is a case where the shares are given to employees. Now, whenever you do Ind AS 102 ka accounting, we find out the fair value of the option. Now, we take what? Fair value of the shares. Correct. Now, if shares are given to employees, we always try. Why is the shares given? Because of service. Correct. Now, employee gives some service. All right, and for this service we give him some shares. Okay, so it's like this: we get some service from the employee and we usually give the shares. But to do the share based accounting, we always take fair value of the shares. We consider fair value of the shares and not fair value of service, because service given by the employee, it's expressed in terms of time. To measure service ka fair value is difficult. Hence, we always take fair value of the shares for our accounting purpose. That's the reason we always say fair value of the shares, fair value of the option. Yes, no. This is the case where share was given to employees. Suppose the shares are given to non-employees, to others like creditors or whoever. You purchase some machinery. Instead of settling in cash, you gave equity shares, right? So, or you took some service and instead of settling for that service in cash, you gave some equity shares. So, if the shares are given to creditors for some goods or service, now we should take fair value of the shares, or should we take the fair value of goods or service? We discussed this in our regular class. So whenever shares are given to others, right? For employees, it is difficult to measure fair value of service because it's a time value measurement. But whenever some other third party is giving some goods or service to you, and if shares are given, means you always take what, sir? Fair value of goods or service, because it's easy to determine. Like normally this particular creditor, if he sells the goods worth 10 lakh, is it difficult to find out the fair value of this goods? No, it is very easy. So hence in these particular transaction, whenever shares are given to non-employees, first priority is always the fair value of the goods or service component. If by chance of this missing, if this fair value, if it is missing, then you take the fair value of the shares. First priority is always the fair value of the goods. Only if the fair value of the goods is missing, then we go for fair value of the shares. We did discuss this in our regular batch, I think. Yeah. Based on this, we have a small question here. That's all. Okay. A simple concept, but that's all is the concept over here. With this in mind, let's read the question and figure it out. Fashion India Limited entered an agreement with RFD on 10th August. Okay. For purchasing a machinery. We have purchased a machinery on 10th August. The arrangement has a clause that FIL, the company, will have to settle the consideration of machinery purchase by issuing it equity shares. So we are a company, Fashion India Limited, which they're calling it as FIL. This FIL company has purchased a machinery and they are settling the amount not by giving cash but by issuing equity shares. So this is what shares given for employees. No, it's a shares given to third party for some goods or service rendered. Here it's a case of goods. Correct now. So which one will you take? We have two components over here: fair value of shares, fair value of machinery. Which one you will prioritize? It is very easy to find out fair value of machinery. Hence, we will always prioritize what? Whenever shares are issued to third party, we will always take fair value of goods or service. Here we have to take fair value of machinery. By chance, if they tell in the problem, fair value of the machinery is not ascertainable, rare case. But if they say so, then we will take fair value of the shares. Here, let's find out. Will the company agreed to the clause and order was confirmed? So we are also okay. That's how the settlement is done. Machinery was supplied wide invoice dated 25th October and delivered on 1st November. Invoice date is 25th October, but delivered on 1st November. Normally, when the machinery gets delivered, we can say control is transferred. So we have to recognize machinery on 1st November wala date. The purchase consideration was 150 lakhs and the fair value of machinery supplied was 160 lakhs. So machinery ka fair value is given? Yes, 160 lakhs. As agreed, Phil issued 1 lakh equity shares of face value 100. Okay, sir. Great. So to RFD Limited, we have issued shares. Now, what they're asking is, as per Ind AS 102. So why will Ind AS 102 come into picture here? So you're giving shares. No? If you're giving the shares, then you have to apply Ind AS 102 ka provision only. The shares can be given to the employees, directors, or third party, but still Ind AS 102 only gets triggered. Yes. So applying Ind AS 102, they are saying what should be the price and the date of recording the machinery. So at what price will you record the machinery and on which day will you record? They're asking. I have given some pointers over here. If the share-based plan, if it is given to others as in some creditors, some other vendors towards goods or service, what we will take, sir? As per Ind AS 102, you should always use fair value of the goods or service received. If the above fair value of goods or service cannot be reliably measured, then only you take fair value of the equity shares issued. In this problem, it's clearly given. Here, fair value of the machinery can be reliably measured. They only told in the question that fair value of the machinery is 160 lakh. So hence, the machinery will be recorded at 160 lakh itself. Okay, Zaru. And when did you receive the delivery? The invoice may be whatever, okay? Because we will get the control of the machinery when we receive it. So the delivery date of the machinery is 1st November. So the date of recording will also be 1st November. It should not be 1/1, it should be 1st November. Okay. So on 1st November, they have not asked the entry. This was what they have asked. What is the value? Value is 160 lakh. The date is 1st November. Okay. So if you want the entry, it will be machinery account debit 160 lakh. To what? To equity share capital. How many shares you issued? 100. And each share ka nominal value or face value, how much they told? 100. 1 lakh shares you have issued. Each ka face value is 100. So 100 lakh will be credited towards equity share capital. Balance will be credited to securities premium 60 lakh. Entry is just for your reference. They have not asked. Even if you want to write, that should be okay in my view. Okay. That's all is this question about. Simple, but a good concept question. Yes, sir. So with this, all the RTP May 2024 questions we have officially completed. Hope the session was helpful to you. All the very best. Take care. Keep your confidence high. That's the main thing that matters in these sort of examination. It's okay. I do understand that some things here and there can happen. You may feel FR is a vast syllabus. No matter how much you try, few things here and there will slip off. So don't be worried too much by what has got slipped off and all. It is all right. It is acceptable. Okay. Sometimes even we also find it difficult to do all the recordings on time. Yes. Because the volume of the syllabus is too much. Okay. So it is okay. Whatever you have learned, believe in yourself that you will be able to remember. Keep that confidence high. It is okay. How much ever you're prepared, go with that positive mentality. Okay. I hope you get the result that you truly deserve. That is pass. Okay. So take care, chartered accountants. See you. Bye bye.